This week on Make Better Wealth Decisions, we're talking with Chris McHaney, who is a vice president at Global X Exchange Traded Funds in Toronto. Chris is an expert in a whole variety of capital market areas and has a great deal of expertise in understanding macro developments throughout the financial services industry. But we had a conversation this week about the aftermath of the US election. What does it mean in terms of tariffs? What does it mean in terms of inflation? And what expectations do you have? And Chris has some great ideas. Have you ever thought about writing down what you think is going to happen and then coming back a little bit later to check to see how right you in fact were?
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John De Goey, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
Welcome to Make Better Wealth Decisions. My guest this week is Chris McHaney. He is the Executive Vice President and Head of Investment Management and Strategy at Global X Investments, which is an ETF company here in Canada. He holds an honors BA from York University and at Schulich, and he is a CFA charter holder as well. Chris, welcome.
Thanks very much. Happy to be here.
Could we begin by maybe having you tell the listeners and viewers about what you do on a day-to-day basis at Global X?
Sure. Actually, a relatively new hire here at Global X. I've just been in this seat for about 3 months now, let's call it. Spent the better part of my career at BMO Asset Management, so on the ETF team there over the last 15 plus years managing ETFs there and mutual funds before that, before we got into the ETF business. At Global X here, I've been brought in to oversee the entire portfolio management team as well as set investment strategy for the firm. So touching all asset classes and being really a good resource for investors and advisors as well. Hopefully I can provide some advice to them as well.
Okay. So let's get into it. We just had ourselves an election 2-3 weeks ago in the US. Everyone is talking about it, and it has an impact on what people's outlook is for what it might all mean. I've had other guests, ironically, the past 2 weeks, my guests have been Americans, and I've not gone there because I've thought of it as being maybe a little bit too delicate and a little bit too close to home. So since you're a Canadian, since we're both Canadians here, we can maybe talk about it a little more objectively. We've had a little more time to digest. What do you think it all means? How at all has it changed your outlook? In what way and to what extent?
Yeah, I would say big picture wise, I would say things really haven't changed. I think, and part of that is because Trump became president first time in 2016, brought in a very different approach to politics in general. A lot of people were not used to that, but some of the trends and policies that he was able to set in place back then really have built momentum and continued to this day. And I'm thinking primarily around this idea of protectionism or anti-globalism, if that's how you want to look at it, re-onshoring of supply chains and that sort of thing. So that was a sentiment, again, that was really introduced by Trump in his first presidency and was actually continued by Joe Biden to some degree. COVID was a big part of that as well, with a lot of countries around the world realizing that they're dependent on a lot of other countries based on what supply chain you're looking at. And so I think that really just built momentum to let's onshore some of this manufacturing capability and bring things back home, so to speak. Again, I think big picture, we're really seeing a continuation of some of the trends we've really seen over the last, call it 8 years or so.
So one of the things that I think is ironic about the election outcome is that the pundits are saying that if you think of, say, David Coletto over at Abacus in Canada, who's a major pollster, Coletto will say that the outcome of the election on November 5th was based on inflationitis, and voters were punishing the incumbent government for the inflation that they've endured over the past little while. And indeed, I think in 10 major elections held in 2024, in all cases, the incumbents lost. And in pretty much all cases, the narrative as to why that happened was because voters were annoyed with the inflation they had to endure, even though, in my humble opinion, that was the lesser of the two evils, that if you don't bring rates down to zero and start handing everyone a check to keep them home, to keep the economy going. The alternative is much worse. We're talking about a global health emergency, and we're talking about possibly having the entire economy go at a minimum into recession and possibly into depression. And so the irony of all this is that we've actually, we being the Western world, not just the Americans, everyone around the world, have done, to my mind, a remarkably good job, a better job than I expected in dealing with COVID. And yet voters, if you ask them to weigh in on this, they'll say, oh no, we're mad at all the incumbents because we feel unhappy. So here is the narrative that I want to run by you to get your take. And I don't know if you want to say this is just your personal take or if this is a corporate opinion for Global X, but what I find interesting is that people voted to throw out the incumbents because they experienced inflation. And the strong consensus opinion of what the Trump policies will entail, given the supply chain disruption we've talked about, the deglobalization, the deportation of millions of migrants, and imposition of much higher tariffs, even higher than are currently in place, will collectively be the most inflationary set of public policy changes that we've seen in the Western world since the Smoot-Hawley tariffs in the 1930s, and we all know how that worked out. Do you share that view? And if so, don't you find it ironic?
Yeah, I would say broadly, I would agree with almost everything you said there. And yes, that's a very ironic outcome for the election, as you say. Also, of course, to some degree, voters being unhappy about inflation. I think we have to remember how much the president or the leader of whatever country you're looking at really has control over the economy itself and what's happening at that moment in time. Typically, what's happening in the economy now is a product of seeds that were planted 3, 4, 5 years ago. And I think the other thing to point out to your point is these elections happen globally, many countries around the world, all dealing with the same thing is inflation, meaning that it likely wasn't any one individual in charge of one country that was responsible for that inflation happening. For example, I'm not sure Joe Biden was the one specifically that was the cause of inflation, although again, there's discussions around how things could have been handled post-COVID, the fiscal policies that were put in place, certainly to some degree, the amount of spending that was there has some element to it, but monetary policy as well, the Fed keeping rates too low for too long, the quantitative easing that was happening for much too long probably had a bigger hand. But again, these are all things we can argue about as to what the specific cause of inflation was, but certainly ironic, as you say, that the candidate that wins is likely going to do more to hurt the issue than to solve the issue. Maybe part of the argument is the other party wouldn't have done anything either to help inflation, which is quite likely also. But I think investors, or not investors, voters are also short-term memories, right? They only remember what's on their plate as of right now. I don't think administrations get bonus marks for working our way through COVID, as you say, at the beginning of the administration. And of course, because we don't know what alternate realities look like, we don't know if we didn't do this, what would have happened, so to speak. I think this is just the nature of politics in general. And anytime something unfavorable is happening in the economy or in the society, generally the party involved or the party in power at the time, you get punished for it.
And of course, the inverse is equally true. The party in power might not be doing anything great, but if the economy is firing on all cylinders, they might very well get credit, even though they don't rightly deserve that either. It's just one of those perversities of the electorate in general. So I had a question about recency bias that I was going to ask you a bit later, but since we've touched on it already, let's talk about that right now. So a lot of what we're talking about as you make better wealth decisions is you're supposed to make decisions in a contemplative, purposeful manner that takes into account all available information and weighs it on a balance of probabilities and makes an informed decision based on how things may or may not play out. That's the theory of what all decision making, but I think in particular financial decision making is supposed to involve. But we've had a scenario here where people are making their decisions, at least as voters, based on the recent experience of we had a lot of inflation in 2022 and that caused some disruption, and we had to really slam on the brakes and raise rates pretty dramatically. And that draconian response had some negative impacts on our portfolios, both stocks and bonds in 2022. And we're upset about that. So I'm wondering if you can comment about the recency bias of voters and whether or not that spills over as some form of recency bias for investors as well.
Yeah, I think so. And as you said, we were just discussing it, but then that voter element, and it seems to happen, quicker and quicker as information flows quicker and quicker these days through online channels. What was a very big story even 3 months ago can almost be moved on and forgotten as of today. And even we are looking at voters in general and in the US election, that first week in November being voters voting day. Again, 6 months ago, things that were happening either in the market or things that the candidates were saying and platforms that were being discussed almost didn't even enter people's minds in the last month or two as we're going towards the polls. It's all about that, again, the most recent story that's on people's minds. And so that's what people remember when they go to the polls. How that applies to investing, very similar ways. And I think what I find works, at least for me and my work and what I do, is I like to just write things down. And it's really as simple as that, as whatever you're thinking in the mind, what's going through your mind at a specific time. Let's write down those 3 to 5 things that I think can maybe move markets and therefore have implications for my portfolio. But also, what are those things? But also, what are the markers that will indicate whether this trend is happening or not, and giving me indications as to which way to pivot the portfolio or not. And you really make it a regular basis. Give yourself your own timetable, whether that's at the end of each week or months, or in case of your investments, maybe you only want to review them quarterly. But write down your thoughts, write down what's happening in the economy at that time, certain levels, where yields are, et cetera. And then look to those potential outcomes and how that'll affect your portfolio. And then remember to revisit that, right? And if you wrote it down 3 months ago, as I'm looking at portfolios today, let's take a look back at what the context was 3 months ago and remind myself, what was the Fed saying? What was Jerome Powell saying about X, Y, or Z? Because he's actually, and central bankers in general, but the US in particular, has been very consistent actually in their messaging. But you have to just cut through the noise and then go back to what were those messages, and is that still relevant today? And do we think it is or not?
Okay, so it's funny because we all collectively have selective information about what we remember, and we always like to remember our winners and pretend the losers never happened. And one of the things that Daniel Kahneman talks about in thinking about how things might play out over, let's say, a year is to do what's called a pre-mortem, where you stop and you reflect upon what could possibly go wrong. And then as you go about your financial decision making, people, it's been shown, are more inclined to make better decisions when they purposefully, deliberately contemplate what might go wrong because they avoid the potholes that they might have otherwise encountered. So let's see if we can play that game right now. Let's just say, what's Chris writing down today with regard to, let's say, the Federal Reserve or the Bank of Canada, with regard to what do you expect with regard to interest rates, prevailing rates going forward for, let's say, the foreseeable future, let's say the next 3 to 6 months. And then I'd like you to then play another game of what do you think could go wrong? What if you're wrong, Chris? So first off, what do you think is going to happen? And then let's play the game of what if you're wrong?
Yeah, that's a great idea. So I think we're at the point right now where we're going to see a little bit of bifurcation between what Bank of Canada is doing and what the U.S. Federal Reserve is doing. We already saw the Bank of Canada act first in terms of cutting rates and starting down that path. And then we saw the Fed sort of follow up with a 50 basis point cut, which was larger than expected, but is now adjusted the pricing of future expectations in the US. In terms of what I think is going to happen over the next 3 to 6 months, I think Canada is going to continue easing on a consistent basis. We'll see regular interest rate cuts at most of those upcoming meetings. We could see another 50 basis point cut, perhaps even in Canada. And this is largely around just a weakening economy and a weakening, but weak in general. It's been weak for a year plus, let's call it, only propped up by immigration, which is also going to somewhat slow down now. And so we see that Canadian economy continuing to stay relatively weaker than the US until, interest rates broadly come down for a period of time. I think most investors, hopefully we remember that when rates were going up, it was all about it takes time for these rate changes to work their way through the economy. Similarly, on the way down, it's going to take time to work through this, and the stimulative effect that Canada hopefully feels from those rate cuts will eventually come through. But we think for the short term, we'll still see continued rate cuts in Canada. In the US, I think we will see some rate cuts, but it will be at a slower pace than what we've seen in Canada. And that could include some meetings, just holding on pause, and then some meetings having maybe a 25 basis point cut attached to them. And that around is largely because the US economy continues to do very well. And that includes, economic growth measures, but also inflation measures, not continuing to trend down, kind of sticking where they are now over the last few readings. So I think the Fed, again, let's go back to what they were saying before, higher for longer, I think still applies here because they're very cautious on that reacceleration of inflation. So I think longer term rates stay fairly anchored in the US where they are, while short term rates come down a little bit. And in Canada, we'll see a broad decline in interest rates.
Okay, so let me interject there. The economist mantra is that monetary policy works, but with long and variable lags. And I think I just heard you say the same thing, only with a little more color and detail. We still haven't really had a discussion about what could go wrong. So from there, I'm wondering if we could maybe talk about the narrative surrounding these rate cuts that I think, both expect. The one narrative is we've achieved a soft landing and everything is fine. And that might be the narrative that I think I'm hearing you say is the dominant narrative in the US. In Canada, in contrast, there is a narrative that we're seeing rate cuts, but because the economy is weak and we need to lower rates to keep the economy moving forward, to keep GDP growing and so forth. I'm wondering what your view is with regard to those two competing narratives. And then again, I'm going to ask you to weigh in on what could go wrong if your view of one of those narratives is, for whatever reason, incorrect.
Yeah, I think this is going to be the challenge, particularly for Canada, as we do see these economies diverging. The Bank of Canada, as we've seen, and I mentioned, acted first in this rate cutting cycle. So they're not beholden to following exactly what the Fed does. But there's also a band around which we really have to stay close to what the Fed is doing. Too much of an interest rate differential causes that Canadian dollar to weaken. Further, that reduces purchasing power within Canada for Canadians and can potentially exacerbate that issue. There is a sort of a limit as to how far our monetary policies can diverge, and that will be up to the Bank of Canada to manage. In terms of what could go wrong here, first of all, it's quite possible Canada can slip into a recession, and that's minimum of a couple quarters of negative growth. I think that can certainly happen in Canada if we see purchasing power continue to erode, if interest rates, those lower rates don't work their way through the system too much or too quickly. Canada's very interest rate sensitive in terms of the consumer with mortgages and things like that. We could see mortgages start to take up a bigger portion of disposable incomes and therefore reduce disposable income and cause downward pressure on the Canadian economy. So I think that is a real risk to Canada and to Canadians. And what could go wrong in the US? There's probably a couple things that could go wrong. And number one is that inflation does stay relatively high. And for the various reasons you outlined earlier, maybe new administration's policies come in and get enacted, and that actually exacerbates inflation so that keeps rates high. At the same time, that increases federal deficits, increases the debt, and increases the debt servicing burden on that economy as well. That could tip that economy into a recession also. That would probably take a longer time to work its way out, but that's something that I think down the road is potentially possible as well. And that could be the worst of both worlds, with stagflation, low growth, but high prices and high interest rates could be a tricky spot.
It's funny because I want to play now too. So I want to offer my idea of what might go wrong, specifically with regard to the U.S. Donald Trump has begun naming his cabinet. We're still 2 months away from him being sworn in as president, but we're getting a pretty good sense of who he's going to want to appoint to his inner circle. And depending on how those appointments go, and depending on how markets react when they get the full breadth and depth of what it is that voters have signed up for. I actually think there could be some significant disruption just as a rejection of the direction of the government, even though presumably the president-elect has a mandate to pursue all the things that he says he's going to pursue. And I say that because a lot of people say you should take the president at his word directionally, but you should not take him literally with regard to precisely what his agenda will be. That's the sort of cold comfort that some people will use because they don't want to contemplate what a literal adherence to that agenda might entail. I guess my question is, what if he means these things literally? I don't think the market has sufficiently digested the possibility of that being the case. And I'm not saying that it necessarily is. I'm just saying it's one of a number of outcomes that we need to consider because it could be what actually happens. Which brings me to volatility. Markets have been largely positive since Trump was elected and since the Republicans have a mandate, both with regard to the Senate and the House of Representatives. But volatility is the sort of thing that comes and goes. I'm wondering if you can comment on market volatility as we draw to the close of 2024.
I think we've seen particularly equity volatility behave largely as expected, to be honest. I think we were telling investors back much earlier this year, even as early as the spring, that anytime there's a presidential election year, there tends to be equity volatility in and around leading into that date. And then you can see that go away once the outcome is known and markets can pick a direction. And that's largely how we've seen it play out here. Volatility relatively high. If investors look at the VIX, for example, as a measure of equity volatility, staying relatively elevated through October and into early November. And then once that election outcome was determined, came back down to what it seems to be the floor now is around 15 or so on the VIX. That tends to be where at the lower end of the range these days. If we look pre-COVID, with, again, a lot of that monetary stimulus that we were talking about earlier, really suppressed financial asset volatility. I think that's behind us now. And so we're in this more quote unquote traditional or normal type of volatility environment. The other thing that you'll see, though, is that on the fixed income side, on the interest rate side, we saw similar phenomenon that rate volatility collapsed after the election, but it's still staying relatively high. The measures that we look at indicate that really fixed income volatility is back to pre-financial crisis type of market. And so this is going back even further than just COVID, but the financial crisis, that period of time really had fixed income and rate volatility suppressed extremely. And now, again, that seems to be behind us with inflation back and interest rates at a higher natural level. That volatility is still there. So again, it's come down since the election, but interest rate volatility is still there. And we think it's going to be here for quite a while, actually.
That's been a good overview of what we might expect, for better or worse. We'll come back and compare notes down the road to see how right or wrong we were with regard to our concerns. We're drawing to the close, so I always like to end with the question that I ask all my guests, and that is, what advice would you give to listeners to help them make better wealth decisions?
Yeah, I think it goes with what I was saying earlier. Let's revisit our conversations. Let's revisit our rationales for the decisions we made in the past and ask ourselves, are these decisions, are these assumptions we made, are they following through? Are they still relevant? Do we need to adjust any of that? It's really about remembering what you told yourself or remembering your own individual decisions in the past, why you did something, what the objective behind that was, and then really, again, reinforcing, is that still true today? Has anything actually changed? Even though it seems like every 3 months we have so many things coming at us that it seems like the world is crazy and it's always changing, but things can do a round trip and kind of be back to where they were within 3 months. And so you have to, again, keep revisiting the past, revisiting what you've told yourself and the decisions you've made already, and then ask yourself if that holds true and if things need to change. And if not, that's great. Keep things where they are. And that tends to be a winning outcome most times.
All right. Thank you, Chris. This has been wonderful. I think the comments about being able to hold yourself accountable for what you believe what you think you believe and why you believe it is a useful bit of insight that I really hadn't heard before. So I want to thank you for your time today, and I want to wish you all the best.
Absolutely. Thank you.
John De Goey is a portfolio manager with Design Securities in Toronto. The views expressed in this programme are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647 Stand Up. That's 647 782 6387 or at jdegoey@designedsecurities.ca.